Seattle's most expensive home listing just lost $30 million in value in less than a year. And it has nothing to do with a bad paint job or a slow market. The house sits at 128 East Lake Washington Boulevard, a 12,000 square foot Georgian estate on a 1.6 acre lot with a private 160-foot pebble beach, 12 fireplaces, a pool, a spa, and a dock that once hosted Barack Obama. 2025 for $75 million. By late June 2026, the asking price had dropped to $45 million, a 40% cut, and the King County assessor had already pegged the property's actual value at roughly $31.4 million, the real deal on. That gap between what the seller wanted and what the market will pay is not a real estate story. It is a tax story. Seattle arrived at a $30 million haircut on its crown jewel property after the governor signed a bill this spring, the signature that started it. On March 30th, 2026, Governor Bob Ferguson signed Senate Bill 6346 into law, officially titled Establishing a Tax on Millionaires. The bill imposes a flat 9.9% tax on Washington household income above $1 million a year, with the tax starting January 1, 2028, and first payments due in 2029. It passed the Senate 27-22 and the House 51-46. Supporters projected it would generate $3.5 billion annually once collections began, with the money earmarked for public defense, the working families tax credit, small business tax relief, and sales tax exemptions. Wikipedia 1. Washington had no state income tax before this. 0. That absence was the state's pitch to entrepreneurs, tech executives, and anyone cashing out equity from a company they built. Amazon, Microsoft, and a generation of startups grew up in a state that let high earners keep what they made. SB 6346 changed that pitch for the first time in Washington's history. Not just one house. The Denny-Blaine mansion is the headline, but it is not isolated. An Olson-Kundig-designed residence in Bellevue saw a nearly identical pattern. It listed at $79 million and has since dropped to $65 million, a $14 million reduction on the state's other marquee estate. 2% of Washington's most expensive homes, both cutting prices sharply, both within months of the millionaires tax clearing the legislature. One price cut is a data point. 2. On the two priciest homes in the state starts to look like a pattern. The mayor who waved goodbye. Here is where the resentment lives. And it is not really about the tax bill itself. It is about how Seattle's City Hall talked about the people paying it. In February 2026, Seattle Mayor Katie Wilson stood in front of a room of supporters and said, "This city is filthy rich." 2 months later, during an April interview, Wilson was asked about millionaires fleeing the state over the new tax. She laughed and waved goodbye on camera. Seattle Times columnist Danny Westneat wrote that the moment went ricocheting all over the country, and noted that this was Wilson's third gaffe in 6 months, following a November 2025 appearance on a Starbucks picket line where she said, "I am not buying Starbucks and you should not either." Former Democratic state legislator Reuven Carlisle did not hold back. "It's just a horrible strategic mistake to have the Seattle mayor effectively be saying, 'Fine, go away,'" he told the Seattle Times. "But you can do it without villainizing people. The language matters. Rhetoric matters. You're going to wave goodbye to your hometown entrepreneurs? We can't pretend that that rhetoric doesn't have a serious impact." The timing lands hard. Starbucks, the company Wilson urged residents to boycott, announced on April 21, 2026, that it would invest $100 million and create 2,000 new jobs in Nashville, Tennessee. Fox 13 Seattle reported the city could lose up to $750 million in tax revenue in the coming years as Starbucks expands in Tennessee instead of Washington. Not on roads, not on schools, not on public safety. That revenue simply moves to another state. Seattle did this before. Seattle already ran this experiment once, at the city level, and the results were on the books before the millionaires tax ever passed. The JumpStart Tax, officially the Seattle Payroll Expense Tax, passed the City Council in July 2020 and took effect January 1, 2021. It applies to companies with more than roughly $9 million in total Seattle payroll that also employ at least one worker earning above about $194,000. Rates range from 0.75% to 2.557% depending on company size and employee pay, and the biggest firms with the highest paid staff get hit hardest. The University of Washington's Foster School tallied the results. Seattle lost nearly 6,000 jobs. Bellevue, right across the lake with no equivalent tax, gained more than 4,000. John Scholes, who runs the Downtown Seattle Association, put it plainly in a piece reported by KIRO Radio. Seattle's JumpStart Tax has jump-started Bellevue's economy, not Seattle's. The downtown property numbers back him up. Scholes said the top 10 most valuable buildings in downtown Seattle are now worth less than half of what they were 4 years earlier. Property taxes are based on assessed value. When billions in downtown office value evaporates, someone still has to cover schools, roads, parks, and city services. That burden did not disappear. It moved to homeowners in Beacon Hill, small business owners in Ballard, and renters whose landlords pass the increase along. The bill is already landing at home. Ordinary Seattle residents are watching their own tax bills climb, separate from anything millionaires are paying. On the August 2026 primary ballot, voters face Proposition Number 1, a $479 million library levy. That figure is more than double the $219 million levy approved 7 years earlier, even though inflation over that stretch ran about 31%, not 100%. If it passes as proposed, the owner of a home assessed at Seattle's median value of $872,000 would pay $193 a year just for this one levy. Citywide, the total property tax rate would climb from $3.02 per $1,000 of assessed value to $3.14. The $3.60 per $1,000, which does not leave much room before Seattle hits a legal ceiling. Here's where it gets worse. The library system stopped receiving full baseline funding from the city back in 2012. Since then, voters have covered roughly a third of library operations through special levies, and those levies have quadrupled in 14 years. This is not a one-time ask. It is a structural pattern where the base budget shrinks and voters get asked to backfill it year after year, ballot after ballot. What the numbers are actually showing. Seattle's own economic editors at the Seattle Times ran a headline on this exact tension in February 2026. Another millionaires tax finds Seattle is far richer than anyone knew. That framing matters. The city government has treated its wealthiest residents and largest employers as a bottomless revenue source. First through JumpStart in 2020, now through the state income tax in 2026. All while courting the same downtown emptying, job exporting outcomes each time. No program sustains itself against math like that. The $30 million cut on the Denny-Blaine mansion does not prove that Seattle's economy is collapsing overnight. Real estate markets move for a dozen reasons, and a $75 million ask was always aggressive. The cut lands at the exact moment the state passed its first income tax in history, at the exact moment the sitting mayor publicly waved off wealthy residents on camera, and at the exact moment a major anchor employer announced it would rather build 2,000 jobs in Nashville than expand in Seattle. 3 separate signals pointing the same direction do not prove causation on their own. They do establish a pattern serious enough that even the people running the city are starting to notice the wave goodbye did not land the way they hoped. Root cause, not just a headline. 2 different things keep getting collapsed into one story here. There is the tax policy itself, a legislative choice with a specific rate, a specific effective date, and a specific projected yield of $3.5 billion a year. And there is the political messaging around that policy, a separate choice about how officials talk about the people paying it. The JumpStart tax data from 2020 already answered the economic question. High earners and large employers are mobile, and a 5-minute drive to Bellevue with no equivalent payroll tax is not a hardship. The 2026 millionaires tax operates at a state level, which raises the stakes considerably. There is no equivalent 5-minute drive out of Washington income tax exposure. There is, however, a real option to reclassify residency, relocate a headquarters, or simply not expand the next facility in the state at all, which is exactly what Starbucks chose to do in Nashville. Downtown Seattle. A single mansion dropping from $75 million to $45 million is one listing. But it sits next to a Bellevue estate that did the same thing. A payroll tax that already cost Seattle 6,000 jobs, and a mayor caught on camera waving goodbye to the people paying most of the bill. Do you think the millionaires tax raises the revenue Olympia is projecting, or does Washington end up chasing the same wealth it's trying to tax? Drop your take in the comments and subscribe if you want the next update on how this plays out.